Thanks a lot for joining on a Sunday morning. Without further ado, let's begin this AMA session. So the flow is like this. So I'll be first walking through the current markets, how they are positioned, and I'll give my take on what we are seeing and how are we reading the markets at this point of time. And then once we take a macro look of how the markets are doing, then I'll deep dive into how our specific small case strategies are performing. And post that, Deepak will give you an overview of what our strategies are about. A little primer into these strategies for someone who's joined new. And then we'll be opening the floor for discussions. So let me share my screen and begin by showing the markets. So I usually do this in our monthly review. So firstly, I wanted to show our Nifty chart. So this is the Nifty's weekly chart, and the moving average is 20 weekly moving average. So you can think of it roughly as a 100-day moving average. Now what you are seeing right now is we are at this stage. We had a big bout of correction during the 2025 starts, or 2024 July onwards, in fact, to be precise, September. After this big bout of correction, we have recovered, and then we are slowly recovering and making a smaller basis. Just a typical volatility contraction pattern. You make a first big base, and then you make a small base, and then you make even further small base, and then you ultimately try to move up. So this is the resistance that we are seeing, which is being present over the last 1.5 years. And it did try to break this, but it could not break during the initial phases of this year, and we're still undergoing this correction. Now, if you look at the macro part of it, it looks hale and healthy. We are not in any deep correction. In fact, we have come out of a big set of correction, and hardly whatever fall that we have seen in a couple of days or last weeks is not even more than, let's say, 5-6% at the index level. But what the index says is different from what is happening in one's personal portfolio, because there's a lot of churn happening within the overall portfolio of the stocks. So if you see the breadth actually has weakened quite a bit over the last 1-2 weeks. This is a net new high versus net new low chart. What it essentially says is how many stocks are hitting a new high, a 52-week new high, minus number of stocks hitting 52-week new lows. If it is red, it means there are more number of stocks hitting new lows. So if it is in red, then it means that the breadth is slowly getting deteriorated. If it is green, the breadth is starting to improve. The more stocks are hitting fresh new highs, then the market has more legs to move. Now when you see that this is in deep red, basically what here happening is that these stocks are exchanging or rotating from one to another, and thereby you see that the market or the index being managed at a similar level, but beneath it there is a lot of pain in one's portfolio, and hence positioning in specific stocks where there is strength becomes really important. This is a secular bull run. We are not in that kind of phase yet. We are somewhere, if I were to take an equivalence in the previous regime, let's say the 2021 to 2023. This is the Russia-Ukraine war post the COVID run, right? We are right now in these kind of phases. If I were to make an equivalence or a parlance, after a severe correction, we started to get up and having a second leg of small correction, and then before we finally take off. We are at this stage right now. Let's see another interesting chart, that is gold and silver. Now gold and silver, what we are observing is that after the significant correction in the month of February, we are now seeing a good consolidation. You see actually a daily chart, you will notice the consolidation. Yeah, this was the consolidation that has happened in gold. This was a peak and this was a trough. You see the long tail of wicks that has been formed, and then from there on the price started to slowly narrow down within very tiny ranges. You notice the size of these candles; they are getting shorter and shorter, and after that a spike has happened in price action, and the gold has moved upwards. And we see that this is going to continue, and the gold is continue to form a higher high and higher lows kind of a base, and start slowly to move up much better than the Nifty. And with regards to silver, silver had a very steep correction, so it is not making what you call as a breakout like how gold has done. Gold has done a breakout, not in typical sense of breakout from the all-time highs, but at least in from the volatility contraction button, it has broken out. But silver is still at near its lows. So a critical level to watch out for silver is this. If it tries to break out, then we'll see a next leg of rally. Now, if you see the overall other markets that are there in the bottom market, the index that I really like is the Nifty Mid Cap 150. The Nifty Mid Cap 150 actually is has not corrected that much like the remaining micro cap, small cap, or Nifty Junior or Nifty 50. It has recovered quite a lot of bit in 2025 and stayed in the same range. You see, it is much closer to its all-time highs. I'll show how closer it is to the all-time highs. It is at 2.5% of its all-time high, and it is consolidating in this tight range. Now let me show you the other chart. Let's say like Nifty Junior. Nifty Junior is in fact way below its all-time high. It is close to 10% from its all-time high. It has still a long way to recover. The mid cap is already showing, mid cap 150 is showing good strength, and small cap is again lagging quite a bit. To compare from all-time highs, it is 15% away from the all-time highs. The pain is more prevalent in the small caps and within mid caps also. Not all mid caps are doing, only the mid cap 150 is doing well. The junior is also not doing great, and Nifty is fine. Nifty is also just like the mid cap 150 is down 3.8 or 4%. That is the scenario with respect to the Indian markets. Let's look at what Nasdaq is doing. Nasdaq is undergoing consolidation after a very good rally, and right now Nasdaq is consolidating in a base kind of formation. Right now it is also gone down a bit. Right now 5% down from its all-time high, but the structure is looking still positive. That's about the markets. I'll show one index that we really like, that we are noticing, is the momentum index. The Nifty 200 momentum 30. I don't want to take you through this. Now, just like any technical analysis that we do, there will be supports and resistances, right? And we will get bothered about what is happening in those critical junctures of supports and resistances. Horizontal resistance is much more prominent than a slanting resistance or a support line. Now, we are at a confluence of these two. One, I'll show the horizontal resistance, that is this particular level of 32,380, and on a Nifty 200 momentum 30 chart. It took a support during the market correction that has started immediately, and then it broke down and fell. And at later point of time, it was trying to overcome this. It could not, it failed. And then second time it tried, again it failed. And then it is now trying again to move up. Now if you see the slanting line, this is the first time it has touched the all-time high, and then second time here. You can draw any lines, any patterns by joining 2 points, but it will make a sense in terms of a trend only if it is touching the third or fourth time. That is when you call a trend reversal. So this trend reversal happened here. Third time it touched and it went back, and fourth time it has now broken out and is trying to consolidate here. So we are right now at this juncture. If you see, this is the 20-day moving average. It is now consolidating at these levels. So what we are seeing right now is the early signs of momentum reversal that is happening. The sideways, it can still go like this and still be above this line. You can definitely say that the momentum has picked up when it actually crosses this resistance. So we are waiting for it, and it is a good zone to accumulate the index the momentum strategies because they are in the zone where they are neither falling down nor going up and being in a sideways fashion. Now that is the overall market picture. Now let's see how our strategies have performed in these times. So I'll first start with our adaptive asset allocation, which is a more balanced strategy. I'll show with the performance on a maximum or since inception. We have launched the strategy on 17th of November 2025. It has almost been 3 months, 3.5 months. Now let me compare it with the large cap as well as multi cap strategies. So over the last 3.5 months, our strategy did around 2.63% versus minus 2.78% of equity large cap. Now this has been mostly stable and going in a secular fashion, giving small increments of alpha over a period of time. That is how it has been allocating. And if you take the composition, right now the composition has a bit of gold, debt, as well as momentum and other factors like value and low. Now the composition keeps changing every year based on the volatility and momentum. That is about adaptive asset allocation. And if you want to know more details about how the strategy is created, what are the constraints, and what is the rationale behind it, Deepak and will do a deep dive later. Let me show you the performance of the other strategy, which is the dual momentum fund. Just give me a second. So this is the dual momentum strategies performance. Again, this was launched in November 2005 on the 20th of November 2025. Since its inception, it has done around 13.57% of returns, and the multi-cap has done minus 3.37%. If you were to compare with large cap, it is minus 3.21%. Now, if you compare this against the adaptive asset allocation, it is a high risk, high return kind of a strategy, and hence you see the such huge gyrations in its overall performance. But still, it continues to maintain a good healthy alpha compared to its benchmark. Now, this has a composition of gold and equity allocation, and the equity allocation right now is skewed towards mid cap space and mid cap and large cap space to a certain extent. That's how it is doing. After the gold correction, it has undergone a VCP pattern and again has broken out, and you're seeing a good rally further on. Now, the advantage of this strategy is that it not just allocates to divergent asset classes, but gives a healthy allocation, not a small allocation just for the namesake, but a healthy allocation, so that you actually reap the benefit of negative correlation, and the strategy pulls out and tries to maintain a lead when something is not performing. Let's say the equities are not doing good, the gold is not doing good, debt or equity vice versa. That's how it tries to manage and maintain the lead. Now, these are the two strategies that we have running since the last 4 months. I will take a break and let Deepak continue from here on.
So, thank you, Shekhar, for that detail. I think there are a few folks who have seen this before, but there are some new folks here who want to understand what the strategies are all about. So here is a quick view on what are the key strategies that we have launched. So one is adaptive asset allocation, the other one is dual momentum strategy. So adaptive asset allocation is an ETF play. So it moves between different factor-based ETFs, gold and debt. So factor-based ETFs like momentum, value, quality, and low vol. And the key points to note about adaptive asset allocation is it allocates weight based on inverse volatility. So that means we give more weightage to less volatile ones and less weightage to more volatile ones. Here we do a monthly rebalancing, so we don't see a lot of churn here. We'll see a more smoother risk return profile compared to the benchmark and also compared to dual momentum strategy. So dual momentum strategy, on the other hand, is a stock play. Here we're not, I think there is a question about whether it is a ETF play or a stock play. Here we look at stocks primarily. In a bull kind of scenario, it would create a 30 stock portfolio. that you would enter into. In a bear kind of scenario, it can go into gold and debt. And in a sideways market, it moves into Nifty 100 and gold kind of scenario. Here, we do a rebalance every 2 weeks. And since this is a high return strategy, we need more rebalancing to make sure we are all the time on the updated as to what stocks are in momentum. And I think Shaker showed you the performance after we've launched it. I just will quickly show you what has been the performance, backtesting performance. So which seems to be very well in line with what we are seeing in the post launch, right? So if you see adaptive asset allocation, it got 2.3% in the last 3.5 months. Overall, adaptive asset allocation is sitting at a return of 16% between gold and Nifty 100 in terms of volatility. So it's slightly higher volatility than gold, even lesser drawdown than gold, but a much higher return compared to gold. Whereas in terms of volatility, it has lesser volatility than Nifty 100, Nifty 500, but still slightly more return than Nifty 100 or 500. So someone who wants to play a defensive game, this is a strategy that would align with you. And like I mentioned, like what we've seen with dual momentum strategy, if you see the actual results, it was at 13% compared to the benchmark, which is doing at -3%. Right, so here as well, you see it has slightly higher volatility than the benchmark, but much higher return, about 25.7% when we do the backtest for the last 14 odd years. Still lesser volatility than something like a mid small cap 400, both in terms of not just in terms of volatility, but also drawdowns. Right, so you see almost a 50% write down with mid small cap 400. With dual momentum, what we've observed, the max drawdown is at -28%. And quickly show you how things move, right? So this is a timeline of how the strategy, the adaptive asset allocation, moves between different ETFs at different points of time. So here you can see, when it started with quality and value in 2010. When we ended the backtesting in 2025 July, you see that the strategy is picked up gold in 2024 December, along with some debt and also some low volatility, and you can now understand, like it probably makes sense at that point, given the high volatility that we are observing with the market. It seems to have rightly gone into low volatility and gold. And further, you want to see the backtesting results compared to a benchmark like Nifty 100. You see the drawdowns has been mostly lesser than the drawdowns of a benchmark. So the blue line is adaptive asset allocation and the red line is Nifty 100. In almost 80 to 85% of the cases, the drawdown of the strategy has been under the drawdowns of the benchmark like Nifty 100. And while keeping those drawdowns, since it's been able to maintain that low drawdown profile, it's been able to also beat the benchmark in terms of rolling returns. So here you see the box plot of the rolling returns. The 3-year median is about 16%, and 3-year median for the benchmark is about 13.6, 13.8%. And on a 5-year basis, it's even better, and a 7-year basis, it's even better, right? So here you can see the on a timeline basis, you're seeing that adaptive asset allocation has been, the blue line has been over the red line in most cases in 3-year rolling returns. In 5-year rolling returns, it's much better, and 7-year rolling returns, you see that the magnitude of difference is large, and the difference is actually statistically significant. Even with the 5-year basis, you see it's statistically significant, and also 3-year basis. Lastly, if you look at dual momentum strategy, on the other hand, I'll compare it with Nifty 500, because we also consider Nifty mid small cap 400 in this strategy. So here you can see the NAV progressing pretty well. Yes, its drawdowns are different compared to adaptive asset allocation. You see, the drawdowns could be slightly higher than the benchmark at times, but in COVID crash, or during the demonetization phase as well, the strategy has been able to keep the drawdowns under the benchmark. And obviously, if you are taking this volatility, the strategy gives you those commensurate returns. So if you can see here, the rolling returns, the Q1, which is quartile 1 or 25th percentile of the benchmark, is almost in line with the 75th percentile of 25th percentile of the dual momentum strategy is in line with the 75th percentile of the benchmark. And here the minimum or the 25th percentile is already beating at a 5-year basis. And here on a 3-year basis, if you see, it's pretty much over the red line almost all the time. On a 5-year basis, you'll see clear difference, clear alpha that is being generated, and 7-year basis, it's even better. So those are that's how strategies have performed in the past, and after post launch as well. And I think now we can break for questions.
Start with some of the questions and try to answer them. Sandeep is asking, what is the universe for the new high-low chart Shekhar showed earlier? Which one, Sandeep?
I think you showed how many stocks.
Okay.
Yeah.
Okay, in TradingView that you are
doing.
No? All right, sure. So there is this free indicator in TradingView. Let me see if I can give the name of that strategy or that indicator. It is called NSE India Market Breadth. You can search NSE India Market Breadth in the TradingView.
I think his question is, which universe are we using?
I think it is Nifty 500. Yeah. Okay. Then the second question is from Abhinav. In the strategy backtesting for dual momentum, when was the last time the strategy would have moved to cash or debt? Deepak, do you want to show?
Yeah, so I think there's only at one point of time, I think it was during the COVID crash, is when it moved to.
You can share your screen.
Yeah, so I'm just trying to pull that up. So in the screen, we're not showing the debt part of it, but I clearly, so what we're seeing is gold, Nifty 100 and Nifty mid small cap 400. We're not showing the debt part of it, but what I clearly remember is during the COVID crash is when last it moved into some part of debt along with gold. So that was the last time.
So gold, the debt component actually happens very less in dual momentum.
Yeah.
Because that is the reason for the high. We want to usually position more of the money in high yielding assets by rotating in gold or equities, mid cap, small cap, and large cap. So only in a situation, let's say, that there are some rules that have broken down in the equities and gold, and the underperformance is, let's say the hell is breaking loose, everything is falling. That is when it goes to cash. But even in the worst cases like COVID also, it did not happen. Gold still rallied up. So it moved to gold. So only in the case where everything is blowing up, blowing down, that is when we move to cash. So far we haven't encountered and seen that scenario yet. Bharadwaj is asking, can you give some details about the strategy? Is this dual momentum ETF based? So as Deepak mentioned, it is a stock based strategy. couple of months back, and Bharadwaj is asking another question. Couple of months back, you did a video saying having equal weighting to multi assets almost performs similar to adaptive, right? Is there any reason behind? Great question, Bharadwaj. What you said is right. That if you are looking at only from one lens of returns, then there is not much difference. But in here, we need to bring on the other lenses also while evaluating the strategy. The other lenses are, one is returns, the second lens is risk, third lens is the duration of drawdowns and the length of the max drawdown. So if you see our charts, we have y-axis as returns, x-axis as volatility, and the each bubble represents the max drawdown. So a great return strategy, which is highly volatile, might not be suitable for individual investors. They might invest in it, but the moment they see a volatility happening, they'll get scared and they'll exit at the wrong time. So when we are creating a strategy for a public retail use, we also need to be cognizant that how can we create a strategy which is good enough in terms of return and also is smoother in terms of the NAV chart. So, and that's how the adaptive asset allocation is chosen in such a way that our trajectory of NAV is as linear as it can get, versus a plain vanilla multi-asset equal asset allocation of 25% gold, international debt, etc. For dual momentum, can you share the transaction analysis chart? That we can't share because that is a detailed proprietary analysis. Maybe we'll be able to show you at the overall NAV level, because there, if we have to show, we need to give out the stocks level data that we had procured from one of the vendors, where we can't share as a reseller. We can only consume it for our own consumption. The second question from Kalyan. I heard about sector-based momentum strategy being launched. What timelines about it?
Right now, we're thinking the next quarter. I mean, not is when we are planning for it. We're still. We've done the backtest. Backtest is complete. We still have to also do some more tests on it, and once we have it ready, we will start launching it and also give you a timeline. So we don't have a precise timeline yet, but we are looking positive about potentially this quarter or the upcoming quarter.
Yeah. So basically, every strategy needs to have a purpose. And if there is no purpose of a strategy, if it is just duplicating the existing two strategies, then we will discard them. We see a great need for an adaptive asset allocation for someone to have a core strategy or a core portfolio allocation where you want lesser volatility and more peace, and gradually beating the benchmark. Dual momentum for an aggressive kind of a strategy of momentum, irrespective of the market cycles. Now, sectoral based momentum will work really well when the universe is dispersed and diverse, and especially in a steady markets that will outperform. Luckily, in India, we have good diverse set of sectors like pharma, IT, mining, real estate, in fact, PSUs, banks, financial services. So that kind of spread actually is not available in many of the emerging markets. Even if you take Indonesia, Brazil, or Russia, maybe even China also, that kind of spread is not there to actually construct such sectoral based momentum strategies. So this should be a good satellite kind of a portfolio, and we will launch it once all the necessary testing is done and once the markets are also conducive, not in this. Okay, moving on to next question. Kalyan is asking, like dual momentum, can we have something like gold, debt and sector ETF instead of specific stocks? Like dual momentum with sector ETFs versus stocks. Great question, Kalyan. I think this is continuation with the earlier thing that we talked about. We'll actually construct a sectoral strategy based on ETFs soon. So Kanand Varma is asking the next question. What part of portfolio should one consider to give weight to these strategies? Great. So this is a subjective call. The reason I'm saying it is, let's say there are people who are at different stages of their lives. Someone who's entering, let's say, recently to the markets in the age of 25s or 30s, maybe you would say you can allocate a higher amount of money towards the small case strategies because you've just started to deploy the money and slowly, periodically accumulate. But some of you might have already accumulated a lot of mutual fund units or stocks. Now to sell them and again invest them, we'll also need to have a tax consideration of what are long-term capital gains that you have had, short-term capital gains. That will require a detailed session. So based on one's risk and age profile, we can recommend. But in general, as a thumb rule, though we are not a SEBI RI, we are only SEBI RI. We can only talk about what are the model portfolios, but not give personalized recommendations. A good way is 18-20 as a good benchmark heuristic for 80 is for the core portfolio, 20 is for the satellite portfolio. Krishna is asking, is this a good entry time now due to war and global impact news, or should investors wait for momentum trend confirmation before investing? Great question, Krishna. Right, fact, if you see, in fact, for the last 4-5 months, you've seen that the markets are going nowhere. There's no momentum. Still, we've been able to deliver 13.5% returns in the last 4 months because of allocation to different asset classes. So, dual momentum and adaptive asset allocation, the advantage is there is no good time or bad time. Any time is a good time. Bharadwaj is asking, what should be a good SIP amount to start with dual momentum? So, dual momentum is a strategy where the minimum investment size is 2.4 lakhs to start with, and then on top of that, monthly SIPs can be done anywhere up to your choice. Now, the challenge will come in some months you might be doing 20k SIP, in some months you might be doing 10k SIP, some months 40k. The SIP amount changes because if you were to give equal allocation to all stocks and maintain the same kind of portfolio as we are suggesting, then you'll need to allocate the same weightages. So let's say right now I'm giving an example of a stock called as Force Motors is there in our portfolio. Force Motors itself, the stock price is somewhere around 7.
Yeah, 50-60k.
50k. Individual stock.
Yeah, 25k.
25k. Force Motors, the stock itself is 25k.
Yes.
So if you were to maintain the equal balance, let's assume that it comes into our portfolio, and if you have to give equal weightage, then the overall portfolio amount to invest also will go up by that amount, because all these stocks need to be brought up to 25k. There is no fractional ownership that you can do. So that time the SIP amount changes. Right now we don't have that high stock prices in our portfolio. So right now 20k should be a good thing. Okay. The next question is from Kalyan. Any reason for not doing any rebalance in dual momentum in the last 3 weeks, while there are almost weekly rebalances during December 8 to February 9th, 10 times? Yes. So Kalyan, if there is no signal that comes in, we will not do any rebalance. If there is a signal to change either any regime, the signals based on that we will be changing. It is good that we are not doing rebalance, because whatever we have continued to hold, the status quo maintains. It also reduces the churn. If the signal comes, then we will automatically change. It is not a discretionary strategy, it is a non-discretionary. We are just executing in between whatever the algo says.
Yeah. And dual momentum strategy is a bi-weekly rebalance strategy. While there is no option in small case to do a bi-weekly rebalance precisely. So, on a weekly basis, we update whether there is a rebalance or not. So, many weeks we send an update saying there is no rebalance as such. So the last one was, maintaining the status quo was good, was the signal that we got. So we just shared that. Yeah. So the question is, due to frequent rebalancing based on market conditions after including small case fee, brokerage, slippage, and STCG taxes, what net XIRR have actual investors received from these momentum strategies? So I'll talk about this from the perspective of backtesting, because that's where we have more data compared to the actual strategy. So right now, whatever results that I've shared with you, the adaptive asset allocation, returns, and dual momentum strategies already includes the fact that there are transaction costs, there are slippage costs. So we every transaction we divide a certain amount of transaction fee. And when we actually, during the back testing, when we buy certain stocks and sell certain stocks, we also accommodate for the slippage. We don't take immediate open price to just we don't assume that, so we kind of take slippage also into consideration. And separately, we have done an analysis on what was the tax impact of the rebalances that these strategies are going through. So adaptive asset allocation is the tax impact is less than 1%. Depending on when you enter, when you exit, it could change, but overall we see less than 1% impact. For dual momentum strategy, it is 1.5% is what we have noticed.
Yeah.
So yeah.
The only thing that is missing is the taxes. Taxes anyhow are personal, and it depends on where you're reading. If it is STC or release. The last question from Kalyan: does dual momentum have silver along with gold? Right now, we have omitted silver at this point of time because of its peak volatility nature. And let me show you an example of how does volatility behave. See this volatility, these are small case dual momentum. It has gone from a peak of, let's say, 117.8 to 103.92. So this is what the volatility that we have with the lesser volatile asset classes like gold, equity, and debt. Imagine if you had silver. Silver is a highly volatile asset class. It actually is on the bottom right quadrant of risk reward space. So that is, it gives higher risk and a lesser return. But when it gives a return, it is very lumpy in nature and it goes worse. So that is the reason for omitting silver and considering only gold.
Next question is, in dual momentum, is there always a percentage allocation to gold or debt, then equity, and then you pick best 30 in equity? Not necessarily. In dual momentum strategy, we could go all in equity, 30 stock portfolio, just purely equity, depending on the market regimes and market conditions. But also based on the market conditions, we go into allocating gold or debt as well. But the short answer is no. We might omit gold and debt.
Yeah.
Cool. I think I assume there are no more questions. If you still have any questions, feel free to reach out to us at research@factorlab.in. We're happy to take the questions on email as well. And Shekhar just also shared the coupon code. You guys have taken time out of your busy lives to join the session, so we're happy to share this coupon code exclusively with you. And so with that, thank you so much. Have a very good rest of the day.
Thank you. Thanks a lot. You can use the code momentum to get a flat 20% off on our 1-year subscription strategies. Looking you forward on our small case strategies. Thanks a lot. Have a nice day.